Good afternoon, everyone. A warm welcome to all of you to the eighth webinar on Master Knowledge Series being organized by the Institute of Company Secretaries of India. As you are all aware, the Master Knowledge Series EEE, that is Enable, Evaluate, Excel, was launched as a capacity building initiative, as a knowledge enrichment initiative, and as an initiative to strengthen the skill base of our members, to update them on most recent developments, and to equip with in-depth knowledge of corporate laws. I feel delighted to share that we have successfully conducted 7 webinars of series which have been a huge success. Today we are here to eighth one, that is on the topic which is lending and investments under the Companies Act 2013. Intercorporate loans and investments are regulated, monitored by the provisions of the Companies Act and other allied laws as well. Every company that wishes to make intercorporate loans and investments, guarantees, and securities need to follow well-defined systematic procedure. All this and more require that the professionals guiding them are adept with the various facets of the law and its finer nuances. To deliberate upon the topic in great detail, I would like to welcome CS Makarand Joshi, a practicing company secretary and founder partner of MMJC. One of the key achievements of his experience of 22 years is creation of MMJC mobile app on the BEAR Act of Companies Act 2013. The recent revision of MMJC mobile app has interlinkages of the act with the SEBI LODR regulations as well. A winner of the Best Secretarial Audit Report by ICSI for the year 2019-20. He is also a member of expert group of Secretarial Standards Board of ICSI, and he had been convener to the ICSI SSB publications, namely Guidance Note on PIT and Guidance Note on CSR, a member of a research committee of WIRC of ICSI. He has delivered various lectures in the Companies Act 2013 and SEBI regulations at seminars organized by ICSI and ICAI and industry associations. Sir, we are fortunate to have you here today with us. We are certainly grateful to you for acceptance of our invitation to deliver on this webinar, sir. Thank you very much. Over to Makarand Joshi, sir.
Thank you, Dwarkanath ji, and it's a pleasure to meet you again. And it is always pleasure to meet you.
Yeah.
And it is a pleasure to interact with all our members. Before I start my session today, I must say that today is a very auspicious day, in the sense that 10 years back on this day, President gave assent to Companies Act 2013, and it got notified on 30th of August, and 12th September, as we know, 98 sections first batch of Companies Act 2013 got effective. So this series which ICSI is running is in the 10th year or 10th anniversary of Companies Act 2013. So all of us who are students of Companies Act, we must acknowledge, and I'm sure many of us may celebrate this 10 years of working under Companies Act or helping corporates. Topic assigned for me today is with respect to loan investment guarantee security under Companies Act 2013. Am I audible?
Yeah, you're audible, sir.
My screen is visible?
Yes, visible.
When I enrolled as a student of Companies Act, I was wondered with one question, that if a 1,000 crore turnover company borrow the money of ₹1,00,000, for example, it still require board approval. Sometimes it may require shareholder approval, public financial institution approval, audit committee approval for sure if it is a related party. And if I am a 1 lakh turnover company and I am bidding for 100 crore turnover, no Companies Act provision says that I need a board. What is this dichotomy? This I was always used to wonder. And the answer to that I got when IBC started getting unfolded. And IBC told us very loudly and clearly, particularly in JP Infra and Jayaprakash Associates Supreme Court pronouncement, that giving guarantee or security of your own property or lending money of yours in some other company can't be an ordinary course of business. So I'll start with my session with this perspective which Supreme Court gave us, that when you lend money, when you invest money of your own in some other business, other than maybe your wholly owned subsidiary, and particularly when you give guarantee or security for somebody else's loan, it is very difficult to believe that it is your ordinary course of business unless and until you are a banking or a non-banking finance company, or 186 says that housing finance companies or insurance companies can also get covered under ordinary course of business. But otherwise, if I'm a manufacturing company, if I'm a service company, if I'm a trading company, believing that giving loan to someone where the director has a conflict, where it's not wholly owned subsidiary of yours, and you are giving loan, then all those approvals get triggered. We are in a 10th year, as we discussed in the beginning, and therefore I believe that the participants are day in, day out practicing 185, 186, 179 and all these provisions. So I would not go through the provisions in detail, but I would like to give a perspective and also like to touch upon some critical questions which keep emerging during the course of discussion. For example, what is direct, what is indirect? Before I jump to that, if we look at a historical development, Companies Act 2013, when this 185 first avatar of 185, where everything was prohibited, no relaxation. And then IBC came in 2016, and then we saw CG Power, IL&FS, JP type of cases, and plethora of cases where either NCLT or appellate authority held certain transactions as preferred transactions, certain transactions as invalid transactions, and definitely that educated everyone, including industry and the regulator. Thereafter, CARO got amended, and now auditor has to comment upon various aspects about loan investment guarantee security, particularly whether it is in the best interest of the company or not. What is the source of funding? Is it borrowed funds? How do you match the repayment of the borrowed funds versus the loan which you are giving? How does that match? Asset liability mismatch. All such issues got covered in CARO 2020. It got prolonged or it got postponed for a couple of years, but now that has become effective and auditors have been signing a report on this. Then we also saw SEBI issuing a circular about what audit committee should look at when they are approving related party transactions, particularly loan investment guarantee security. Then we saw LODR amendment about it, and the minimum information which is required to be disclosed to audit committee before they approve. Those are also in similar lines, that what is your source of funding? What is your repayment schedule for your borrowed funds? And what is the repayment schedule which you are giving to your own lending? How much of your lending is repayable on demand? Whether they are capable of repaying on demand. All such aspects SEBI expected audit committee to dwell upon. And now we have a very much matured, evolved, and a lot of framework has been placed to ensure that we don't want another wave of IBC, another wave of insolvent companies coming into the ecosystem. One of the key learnings of all these insolvent companies was that either they were not able to cope up with the changing dynamics, or the second reason is very predominant, or they were using the money raised from the investors or the lenders in not their business, but in some other businesses. Typically, in a criminal law, we call it as a siphoning of funds. In Companies Act, we call it as a loan investment guarantee security by passing a board resolution or an audit committee resolution or a shareholder resolution or a public financial institution. IBC taught us that even if you pass all these resolutions, but still, if the transaction is not in the best interest of all the existing creditors, and if there is no commercial reasoning for this transaction, then these transactions can get questioned and can be held invalid. And therefore, this has set a tone for all the practitioners and compliance professionals and auditors to look at this provision from a different perspective. When we see the Amazon jungle of this Companies Act, this is not a 185, 186 alone. If we talk about loan side or an investment side, it starts with section 67. 67, we all know that you cannot invest in your own shares. And section 19 says that you cannot invest in the shares of your holding company. 67 also says that you cannot finance purchasing of your shares or of your holding company. So 67 talks about prohibited purpose. 185.1 talk about prohibited parties. 185.2 talks about permitted parties but conditionalities. And 185.3 talks about some exemptions. 186 entirely talks about loan investment guarantee security to a person and investment in particular only in body corporate. So these keywords become very critical: person and a body corporate. 177 says that whenever you give a loan investment guarantee security to a related party and majority, a forum where majority are independent, they should give a prior approval, only then you can lend or invest. And 188 says that if the transaction is not in ordinary course and arm's length, then, and if it is beyond a particular size, that is 10% of the turnover or the net worth, depending on whether it is related to turnover or whether it is related to property, it will require non-related party shareholder approval. And then we have a little harmless provision of 179, which says that every such transaction requires board approval. Now, 179 says that every transaction requires board approval, but it can be delegated. And 186 that it cannot be delegated. It requires unanimous approval only at a meeting. So how do you read these two? Those kind of issues also come up. When you are particularly acquiring shares of another company for a consideration other than cash, that is, if you are acquiring some asset by issuing your own shares, and if the transaction with related party, then 192 also get triggered, which requires a valuation report to be obtained. And therefore, when it comes to loan investment guarantee security, the provisions which we have to look at is very, very complex. I will try to put these provisions in a pyramid shape, which will help us to comprehend this subject in a simpler manner. And while for various purposes, board or audit committee has to give an approval, they have to remember that section 166 and 184 becomes a guidance factor for those directors who are interested and those directors who are not interested in this transaction to approve. If a director is interested, his job is little simpler. He will have to disclose and abstain. That's a simpler job. But the directors who are not interested, their job becomes very, very complicated, because in one of the recent pronouncements, SEBI has debarred few of the independent directors sitting on the board who approved certain transactions with respect to making investment in the group companies about when the particular enough information was not disclosed. So SEBI has not been shying away, and they have been very aggressive to look at independent directors. So the role of non-interested directors in approving transactions become all the more critical whenever some director is interested. So we'll look at what all they should look at and how do they can safeguard each other, or how they can safeguard themselves and the company. Caro report also is the guidance, and if you have foreign investment, then there are conditionalities about downstream investment and do's and don'ts about downstream investment. Those also we may need to look at. There are valuation requirements either under Companies Act or under Income Tax Act. Those also will have to be looked at before making any investment, whether it is the right issue or a private placement or other means. Although Companies Act may give exemption for right issue, Companies Act may give exemption under 186, but income tax does not give any exemption from procuring a valuation report with respect to any investment or any allotment of shares which any company is doing. So these nuances we have to keep in mind. First, we will discuss about loan guarantee security, and then we'll go to the investment part. We'll discuss in this basket process some critical questions and some case laws. This pyramid tells us, this is a very interesting pyramid. This is a wisdom pyramid, which I call, when it comes to loan investment guarantee security. At the bottom of pyramid, there are transactions which are prohibited. So once 67, section 67 says prohibited purposes, and 185 says prohibited parties. 185(1) says prohibited parties. We all know this. I may touch upon in the flow, but I presume that everybody knows this. So I'm trying to consolidate everything and give a different perspective. When any transaction comes to me for giving loan, one is that everybody looks at whether it is a prohibited party under 185(1). But we also have to see what is the end use of the borrower. There are two conditionalities which you have to keep in mind. He cannot be using this money for purchasing your holding company shares. Particularly non-banking finance companies or particularly broking companies have to be very, very mindful about this provision. If you are a broking company and if you provide a margin funding to your customer, and if your customer purchases your shares or your holding company shares, then it becomes a violation of Section 67. So those companies who are ordinarily in the financing business, either NBFC or brokers, they have to be very mindful about lending. There can be general authority which may be delegated, but there has to be a covenant. The money cannot be used for the purchasing of your or your holding company shares. Section 67(3) gives exemption to banking company, but it does not give exemption to its non-banking finance companies and broking companies. Again, 185(1) talks about prohibited parties, which we'll go discuss as we go in detail. Whose approval is required is another, the little upper layer of the pyramid. So audit committee approval, board of director approval, shareholder approval, public financial institutions approval, all of their approval is required. Audit committee under 177, board under 179 and 186, shareholder under section 67, 185, 186 or 188, depending on what gets triggered, and public financial institution as per section 186 subsection 5. We all know these provisions well, and therefore I may dwell upon it in detail, but these things we have to keep in mind. So if it is a related party, then we have to see whether it is the 185(1) prohibited party, then even audit committee cannot approve, even shareholders cannot approve, because it is a prohibited transaction under 185(1). Whenever there is a dispute between a negative provision and a positive provision, negative provision always wins, and therefore 185 starts with the word no company shall give, and therefore 185 will win over even 188 or 186. Similarly, whether I am taking a transaction to the shareholder under 188 or 185 or section 67, depending on that, who will be eligible to vote, that will change. If I am taking a transaction under 188 or under LODR as a related party, then obviously my related party or all related parties, depending on whether it is only 188 or LODR, they will not be allowed to vote. When you are taking the transaction to the board or to the audit committee, what all minimum information which is required to be disclosed? In earlier days, companies used to, in the agenda, used to say that the company proposes to give loan to ABC Private Limited, board is requested to approve it. Then the minutes used to say that, okay, board discuss the detail in brief and approve it. Now, after 188 and Rule 15 arising out of 188(1), or Caro report or SEBI circular of 2021, it gives us a lot of guidance about what is the minimum data which you have to place to the board or to the audit committee, whoever is the decision-making authority. One may say that this particular provision of LODR is not applicable to unlisted company. However, I would say that even if you are a private limited company or an unlisted company, this SEBI circular under LODR gives a very good guidance as to what is the minimum data which a director should discuss. And if they discuss this data, and if they have a rationale for their decision making, then definitely, even if a regulator questions their decision, they stand a better chance to defend their case well. Because whenever there are such commercial decisions, and whenever there is a related party, whenever there is a conflict of interest, as I said earlier, the non-interested director's responsibility is very, very high. And they will have to demonstrate that the proper disclosure was made to them. They took a proper, fully informed decision. They have to ensure that there is a process for taking those decisions. And they also have to ensure that there is a proper rationale and which is recorded in the minutes of the meeting as per secretarial standards. Now, these four principles which I just narrated, disclosure, fully informed decision, proper process being followed, and a rationale for each decision, these four pillars are globally called as business judgment rule. Business judgment rule tells us that whenever any fiduciary takes a decision, and if he has done that in the best interest of the company and after following a fully informed, after following a proper process and a proper rationale is provided for the decision making, then that becomes a defense against the prosecution which may be launched to them. Provisions of Companies Act also say that if the transaction is conducted in a good faith manner and for bona fide purposes, then that becomes a defense. And these four pillars, that is disclosure, a proper process, fully informed decision, and a recording of rationale. If these four pillars are followed, then definitely it gives you a sustainability in terms of the decision making, and the liabilities of the fiduciaries can be restricted. So this was just a tone setting kind of an exercise. Now we'll go to prohibited purpose, prohibited parties, permitted parties, and so on and so forth. First, we are discussing LGS, that is loan, guarantee, and security. As we have already seen that prohibited purpose, we already know you cannot be purchasing your own shares. 67(1) says that you cannot purchase your own shares, and 67(2) says that you cannot even finance purchasing your own shares. So even if you are not purchasing shares directly, even if you are not purchasing shares indirectly, even a financing of shares for the purchase of the shares is also prohibited under section 67. The only exemptions are to the banking companies. There is no exemption to non-banking finance company or to the broking company. There is an exemption under section 67 with respect to scheme approved by the shareholders by way of special resolution if the beneficiaries are either the directors or the KMPs. For the employees who are not a director and not a KMP, you do not require any special resolution so long as the amount does not exceed more than 6 months' salary of that particular employee. So these are the covenants. If we see, Dwarkanath sir, the exemptions under section 67 and 185 and 186 even, one commonality which we observe is with respect to ordinary course of business. 185 also gives exemption to lending companies which for ordinary course of business. 67 is a little narrow. They only give exemption to banking companies. Loans to employees is completely exempted in 186. That loan to employees exempted, that theme we also see in section 67 and section 185. Probably the reason is when I am financing to some other company, it is not my normal course of business. But if I am helping my own employees for their day-to-day life, it is my ordinary course of business. To take care of my employee, to take care of their financial needs, where they will look at in all old days, at least when NBFCs were not so widespread, and when banks also had some restriction, employee used to look at employer to help him in the financial need. And that phenomena still continues with respect to many workers or a blue collar or even white collar employees, because many organizations want to help their employees out, and helping employees in an ordinary course, and therefore neither section 67 nor 185 nor 186 principally applies to them, although there is a change in language, some nuances which we'll have to look at for sure. 67(1) also uses the word principal. 185(2) uses the word principal business, is another terminology which we'll discuss when we compare 67(3) versus 185(2) and 3. There is a reference of principal business. Money has to be used for its principal business. And 67 says that you cannot finance for purchasing your own shares. So these nuances also we have to look at. We will discuss difference between ordinary course, principal business, and carrying out business, which is also coming under 186. So what is the difference between the three? That also we will try to dwell upon. When it comes to prohibited parties under 185(1), 185(1) specifically, we all know about this, that the director of the lending company, but it does not, 185(3)(a), although directors you cannot give loan, but to managing director and whole-time director you can give loan, because it is presumed that he is an employee of the company. Director of holding company is many times, I have seen, while ensuring compliance, this aspect gets missed from many compliance professionals. So this we have to be very careful about. If your director is carrying out or is a partner in any firm, this details has to come in MBP1. So MBP1 we may have to tweak. Many good companies have already tweaked, enhanced the scope of MBP1, rather than putting that simple format which Companies Act rules prescribe. They'll ask a lot of data to collate the information from Section 276, that is related party, or from 185 angle or other way. So you have to pull this data as to which are the firms in which he is a partner and who are the partners of those firms. That data also needs to be pulled in. The firm in which the director or relative of such director or holding company is a partner, that firm also you cannot give loan. One common question which keeps coming up is whether LLP is considered as a firm or a body corporate or both. And this also we'll try to dwell upon. LLP is definitely a body corporate because body corporate has defined under Companies Act and has defined under various Supreme Court pronouncements. For example, SP Mittal versus Union of India. There, the definition of body corporate was explained in Supreme Court, where they say that any entity which is incorporated and has a separate legal entity. Incorporated does not just mean registration. Incorporated means corporation, incorporation under particular statute by which you are given a separate legal existence. So LLP is definitely a registration, incorporation, and also it has a separate legal entity, and therefore LLP is definitely a body corporate. Companies Act definition of body corporate only says that body corporate includes a foreign company and does not include a cooperative society, but it does not tell us what is LLP. LLP Act says that LLP is a body corporate, but what is body corporate is defined in this common law principle. Dwarkanath, we have seen this many examples in Companies Act where the term is defined but not defined. For example, this body corporate includes foreign company but does not include corporate. But what is body corporate? Not explained. Or Section 180 says that undertaking is an undertaking in which you hold more than 20%. But what is undertaking? For that, you have to go to common law principle, that is some High Court or Supreme Court pronouncements like Brookbond, India versus Ministry of Corporate Department of Company Affairs, which was with respect to whether sale of investment in a subsidiary will be considered as an undertaking. So there they have defined what is the undertaking. But 180 or earlier 293 always used to say that undertaking means an undertaking. But what is that undertaking? That sometimes becomes very tricky. So I was telling body corporate. But whether LLP is a firm is not defined under Companies Act. We have seen in common law principle that whenever, or the interpretation principle that wherever any term is not defined, we have to go to first a dictionary meaning, and then we may take recourse under other statutes and then evaluate whether a particular word, what does it mean? So firm in a dictionary meaning means any business. It includes even a company. Firm is also defined under Partnership Act to say that partnership firm registered under 1932 Act. And income tax says that firm includes partnership firm or LLP. LLP is definitely a partnership, but is it a firm is a question which keeps deliberating. Whenever there are such scenarios, a purposive interpretation may help. It is easy to conclude that LLP is a body corporate and therefore not a firm. But is it difficult to believe that LLP is a partnership but not a firm? I hope I am communicating. It is easy and convenient for all of us that LLP is a body corporate and therefore not covered under 185(1). But it is difficult to convince that LLP is a partnership firm but still not a. It's a partnership but still not a firm. Why income tax treat LLP at par with partnership firm and not a company? The reason is withdrawal of capital and drawal of profit in LLP is at par with partnership firm. It's not at par with company. And therefore 185(1), if the purpose of 185, if we look at, it's prohibition of loan given to the director directly or indirectly. Directly or indirectly. And therefore firm is equated at par with individuals in 185(1). Firm is equated at par with 185. Otherwise, you do not see any entity. Those are all individuals. Director of lending company, director of holding company, partners, and relatives who are predominantly assumed to be individuals. Firm is the only entity. Why firm is equated? Why firm is treated negatively and why body corporate is treated positively is because of the utilization of fund is restricted in body corporate and not so restricted in a firm. Now, if this is the context, whether LLP will be looked at as a body corporate and given exemption under 185(2), or we will say that LLP is not a body corporate contemplated under 185(2) and therefore not under 185(1) nor under 185(2) and therefore only under 186. And loan is not a service and therefore not even under 188 and will require only board approval. If that kind of a view one wants to take, he has to be very careful that 185 is non-adjudicatable offense and 185 violation is direct conflict of interest kind of a situation of a director which one have to look at. I have not given my view, but I have given the overall perspective and what it is leading towards, that also I have tried to share. When we go to 185(2), Dwarkanaji, can I go ahead?
Sir, please go ahead, sir. Please go ahead.
Yeah. If there are any questions for the participant, they can probably write down in a chat box, right?
They are already sent, I think, nearly 8 questions,
Okay.
which we will take it at the end. I mean, after 5 o'clock, please.
Sure.
Thank you, sir. Thank you.
Sure. So 185(2) says that 185(1) is negative. It says that no loan can be given. So 185 is positive. It says that a company may give a loan or guarantee or security. And also there is one more word, that loan represented by book debt. What is that? That also we'll discuss as we move forward. But they say that you can give that 185(2) is a positive, affirmative, allowing, enabling provision, and 185(1) is a negative provision. So whenever there is a conflict between a negative and positive, who will win? Negative will always win over a positive. 185(1) is greater than 185(2), and 185(3) is greater than 185(1) and 185(2). So this is how mathematically you can look at it. Three entities they have explained in 185(2). 185(2) uses some different words where they say a person in which director is interested. Now they are not using related party definition, and they are not, although the explanation talks about all entities, 185(2) uses the word person in whom any person in whom any director of the company is interested. What is person? That also we will discuss, because person word is coming in 185 also and 186 also. So whether HUF is a person, whether trust is a person, company is definitely a person, because here also we can see that 185(2) explanation includes a private limited company in which a director is a director or a member, a body corporate in which my directors, that is lending company director, control or exercise more than 25% of the voting, or a body corporate, a managing director or a manager, of which are accustomed to act as per the directions and instructions of the board. Now, what is this accustomed to act is another question which keeps coming in mind. So Dwarkanaji, I respect him a lot, and he may say that, Makaran, you please stop now and I want to ask you a question, and I will go as per his view. Will it mean that I am accustomed to act as per his instruction, or will it mean that I respect him a lot, I love him, and I admire him, and therefore I listen to him? Probably it is other way. It is not accustomed, but it is love, respect, and recognition of the hard work of Dwarkanaji has done and the role which he is playing as facilitator in today's position. And therefore, a shareholder writing a nomination letter to a director and director acting upon it, will it be treated as accustomed to act? My view is no, it's not accustomed to act. Accustomed to act is something which you can prove that if you find that some erratic, irrational decision is taken by someone where there cannot be a reasoning, and he has done that based on the instructions or directions of someone, then you will say that he is accustomed to act. Or the person who is exercising power, he does not have that credential, profile, and caliber to perform a role. For example, we have seen the companies where maybe the office boys of the companies are made as a director of the company or otherwise. So they may not have the credential and profile, and the investigating agencies or the ministry may accuse a person that you are accustomed to act as per the instructions. So accustomed to act necessarily need not cover every director who is appointed by the shareholder. The shareholder have a power to appoint or remove, but a director has an independent duty and responsibility to take decision in the interest of all the stakeholders. This is arising out of 166 subsection 2. And therefore, JP Infra and Jayaprakash Associates, although they gave a loan to a holding company, but it was not in the interest of the creditors and lenders of the company, and therefore it was considered as a ultra vires the transaction. And therefore, what I'm trying to say is, accustomed to act is something which comes only when there is a mala fide or a mens rea kind of a covenant. Whereas voting and control, the first two conditions of 185(2), that is the private company in which director is a director or member, or voting and control, are specifically measurable thing. One more covenant which 185(2) prescribes is that you need to pass a special resolution if you want to give loan to such entities, and that's special resolution. In the explanatory statement, you have to give full details about where the money is going to get utilized. And second condition says that the money to be used by the borrower only in the principal business of its activities of the company. What is principal business, that we'll discuss in the next slide. And 185(2) and 185(3) is again talking to each other, which we'll discuss when I go to 185(3) slides. But collating this data with respect to private company in which director is a director or member. Now, sometimes this question comes that if I am my director is a nominee shareholder in another company, because you, for the purpose of wholly owned subsidiaries, you may require a nominee shareholder. So he is a nominee shareholder, not a director in a private limited company. Whether it triggers 185(2) and therefore requiring a special resolution to be passed, or 185(2) presupposes that he should have some personal interest in the private limited company and not a nominee shareholding is contemplated. I feel the other way. A nominee shareholding is probably not contemplated under 185(2). It is the actual shareholding. So literal rule, if we go, it is if he is a member and if it is a private limited company, irrespective of whether he is a beneficial shareholder or a nominee shareholder, it will trigger compliance of 185(2). But if we look at principle, and if the matter goes to the higher court, probably higher courts will definitely agree that here it is about person in whom director, the definition is person in whom any director of the company is interested. And a nominee shareholder can't be considered to be interested in that particular borrowing entity. It's a very, very simple thing. Explanation. What is explanation? That is also deliberated in many pronouncements. And they say that explanation is to forward the purpose of the term which is used under the act. And sometimes it may go beyond the power, but it is to forward the purpose and the meaning assigned to that particular thing. And therefore, this explanation will have to be read in the context that it is about person in whom director of the company is interested. Now, interested, when we say, there are two things which appear from the definition. One is I have an economic interest, or two is I have a capacity to influence them, because the accustomed to act and 25% control or exercise indicate that even if I may not be the actual beneficiary, but if I have capacity to influence the decisions taken by that borrowing entity, even that will be covered under person in whom director of the company is interested. So these two principles which are arising out of that explanation will have to be kept in mind when we are interpreting this particular explanation. Coming to the one more important point is that 185(2) does not prescribe minimum details to be disclosed in the explanatory statement. But if we do not cover all the factors with respect to the resolution which we are going to pass, subsequently shareholder may challenge this resolution, saying that some important factors were concealed from us while taking our approval. And therefore, since there is a concealment of information, and therefore this resolution becomes null and void. In one of the very recent pronouncement of SEBI, when one of the bank was appointing some of the directors on the board on that bank, and the resolution was proposed for the shareholders' approval, and those two individuals were also acting as director in other group companies of that bank, and SEBI had levied some penalty with respect to negligence or something like that on those directors. Those details were not disclosed by that company in their explanatory statement, and therefore SEBI levied a penalty. And therefore, what is full particular? Whenever regulator gives a list of things to be disclosed in the explanatory statement, actually our job is simple. But when they do not give that list, and when they say that you disclose full particular, then the responsibility becomes very, very onerous. It's not convenient. It is onerous. Because if we do not disclose, then this transaction can be considered invalid. Not disclosing can tantamount to concealment of the information. Like I was sharing one of the related party transaction of a large group of companies in Maharashtra here, where one group company invested in the shares of another group company when they acquired the shares from the promoter, and certain information was not disclosed to the board when the board took decision. Even the independent directors were debarred by the SEBI. It is in appeal now, but this is how explanatory statements will have to be looked at. Now, with respect to principal place of business and ordinary course of business, there are certain pronouncements which give us guidance about what is considered as principal place of business. Principal business, not principal place, principal business. There are 4 types of parameters which we observe in various regulatory frameworks. For example, non-banking finance company, RBI says that if your asset and your income, both, if your asset and your income, both if it is more than 50%, then you are deemed to be considered as a principal business in lending or investment. Whereas Section 186 says that what is the investment company? That is your income or your asset. It is, if it is of investment nature, even if either exceeds more than 50%, then you are considered to be principally in the business of investing. So these 2 definitions we already have. Then there is one income tax appellate tribunal in Venkateshwara investment, and similarly there is also one IT80 pronouncement with respect to Shardul Securities, where they say for determining if there are multiple activities carried out by the company, the activity which contributes the largest, this was Shardul Securities pronouncement. So one activity is 30%, another activity and other activities are 15-20%. Then the activity which is contributing 30% will be considered as a principal business activity. In Venkateshwara investment, IT80 further goes on to say that for determining whether an activity is a principal business or not, we may look at this year's number. We may also look at your memorandum, article, past history, and current deployment of the capital and the breakup of investment, all or 4 categories. We will not just look at your current balance sheets number. We will also may look at your historically what is your principal business, and depending on that, we will determine what is your principal business. So out of 3 definitions, I feel that this income tax pronouncement of largest contribution and largest exposure from the company side can be a good guidance with respect to deciding as to whether this is the principal activity or not. Because the money lent by us has to be used in the principal business, only then he will be eligible to claim exemption under 185(2), not otherwise. And when it comes to ordinary course of business, this is the Supreme Court pronouncement with respect to again JP Infra case, that activity would become an ordinary course of business of a particular corporate entity if it falls in a place as a part of the undistinguished common flow of business. So an ordinary course of business has 2 characteristics features. The transaction should be ordinarily, I should be carrying out very ordinarily, and the way in which I am carrying out a transaction should also be in ordinary course. So there are 2 characteristic features. The transaction should be ordinary in the normal course, normal flow of my business, and 2 is about the transaction, way the transaction is carried out, it should also be an ordinary way. So like I engage, for example, in 188, like I engage is any supplier, I have to engage with related party also same way. It's not just about matching the price. I will look at the profile, I will look at the financial strength, I will look at their people strength, I will look at the testimonials, I may procure some bank guarantees, I may look at some third party, I may require some technological support from someone. So all those parameters which we otherwise look at, that way we have to conduct is the ordinary course. When it comes to 185 context, ordinary course is used in 185(2), 185(3), I'm sorry, that they give an exemption that if your business is lending or a lending guarantee security, if it is an ordinary course of business, then 185(1) and 2 does not apply. Here, ordinary course means it should be my ordinary business to lend money, and the context probably expects that I should be in the lending business. So either a bank or NBFC or maybe such category, CIC, such categories only would be exempted under 185(3). So 185(3) has again 4 exemptions. For employees, it's a clear-cut exemption. For a managing director, a scheme approved is a clear-cut exemption. A managing director who is in employment, if he is given loan as a part of scheme which is available to all the employees. Many times, Dwarkanath sir, people ask me that I have a scheme, but the only beneficiary is the managing director. Will that be okay? And then I help them recall that Supreme Court had said in Sahara case that we will not judge you based on what you say, we will judge you based on what you do. And therefore, if you have a scheme but no beneficiary and only managing director, then it will be very difficult to prove that the scheme is actually extended to all the employees. It will be very difficult to believe for an adjudicating authority that the scheme was available to all the employees, but none of the employees availed the scheme, and only managing director, that poor chap, availed this benefit. So that care we have to take when we are dealing with such kind of a situation. And then, of course, loan guarantee security for wholly owned subsidiaries and guarantees and securities for your subsidiaries are also exempted under 185(2). When we talk about 185, there are certain common interesting questions which keep coming, that whether LLP is a body corporate or a firm. This we have already discussed in our earlier discussion. My hunch is that it will be difficult to conclude. And when we say that LLP is a body corporate, yes, body corporate, but it does not have a board of director, and neither it have a general meeting in which this total voting power in the context of total voting power described under Companies Act is applicable, because LLP Act does not have an ordinary course, ordinary resolution or special resolution. It's a partnership, and therefore either majority partners or all partners consent is required, and therefore it is not a body corporated contemplated under 185(2). And however, for the purpose of indirect lending, it may be treated as a firm under 185, and we have to be careful about claiming exemption for a LLP from 185. Similarly, 67 and 185 uses directly or indirectly. Many times this question comes that the word indirectly is referred in one section, not referred in another. There is a Supreme Court pronouncement, many pronouncements, which says that the thing which you cannot do directly, you cannot do indirectly. And therefore, it is not required to mention the word indirect. Whenever there is any negative provision, it is directly and indirectly always. Out of abundant caution, lawmaker may use the word directly and indirectly, but it doesn't mean any different thing. There are 2 pronouncements, very important pronouncement, which describes what is indirect loan can cover and what it cannot cover. There is one Shriram Mills case where court had said, I'm not remembering which court, whether it was Supreme Court or some court from South, where the court had said that 2 things are important. One is that the intention at the time when the transaction entered into should be of a lending and a borrowing, and this intention should be of both the parties, the person who is giving money and the person who is receiving money. Both the parties should have this intention. This case in Shriram Mills, Dwarkanath sir, this was an old case where there was a managing agent concept was there before 1970s, I think. And that managing agent had not withdrawn his remuneration and he'd retained it in the company. And then it was an allegation that since he is not withdrawn, it will be presumed to be a loan given by him to the company. And their court held that non-encashment of that liability does not mean that he had lent it. There should be a positive affirmative action of both of the giver and receiver, and the intention should be such, only then it is loan, otherwise not. And in Freddie Mehta, Purchase Register of Company, Bombay High Court case, where property was disposed of to a director and the payment to that property was to be paid in installments, some now, some in 2 installments. And ROC said that this credit which you have given to the director is indirectly a loan only, and therefore violation of erstwhile 295. There Bombay High Court said that word indirect cannot cover something which is not loan into a loan. This is an underlying transaction is of a purchase of asset, and it's only a deferred payment. And therefore, it is about deferred payment and not a loan. You cannot consider something as loan which is not a loan. And in this background, 185 brought in two words. That is, you cannot be giving directly or indirectly that loan. And it also says that a loan represented by book debt is also prohibited. And therefore, this question comes as to what is this loan represented by book debt, and for whether Freddie Mehta case or whether Shriram Bill case is still relevant. I feel that the word is loan represented by book debt, and therefore essentially it has to be a loan. These words have been inserted in 185 to curb any camouflaging of the transaction by way of, you gave advance to someone and then subsequently you cancel a contract and then take the advance back. Such type of transactions may camouflage. Institute of Chartered Accountants has issued one guidance note, because in Caro report, auditor has to comment as to whether a particular advance is in the nature of loan or not. And they have given some 3-4 guidances, which says that if I am giving you an advance and you are not in the business of that particular, for example, I gave you advance for procuring a stationery and you are not in stationery business at all, then it is the auditor has to suspect that probably it's not an advance but a loan, or the time period which a supplier is taking is disproportionately longer than which otherwise he would take. Then auditor has to suspect that it is not an advance but a loan. Or if the value which I gave you an advance and the value of transaction, if it is disproportionately higher to the underlying value of transaction, then the auditor has to suspect that probably it's a loan. And therefore, indirect has two meanings. One is that hopping, that if I am not allowed to give loan to Mr. X, I give to Y and Y give it to X, and therefore it is an indirect loan. Or I give an advance to X and give a property advance and not entered into that transaction at all. And that transaction is happening, such situation is happening again and again. Or I give a loan to someone of the 100% value of that underlying property as an advance, then it is not an advance but indirectly a loan. Or I am giving an advance and charging interest, then probably it's not a advance and not a book debt, just a book debt, but a loan. So this is, we have to keep in mind. Section 179(3), I am coming to sanction versus give. 179(3) allows us to give loan, board has to pass a resolution, or board can delegate that power to the committee of director or to a managing director or to its principal officers. Whereas 186(5) says that all the transactions sanctioning loan guarantee investment security will have to be done at a meeting and with unanimous consent of all the directors present. So it's a very, very demanding kind of a compliance. It's not only at the meeting, but also unanimous. There are only two scenarios where unanimous consent is required, to best of my knowledge, best of my memory. One is 186 and another is 2033 third provision. So unanimous approval. So many times we feel that when it comes to 179 and 186, definitely 186 is talking about investment in body corporates or securities and loan to a person or a body corporate. Whereas 179 is about any investment. It may be an investment in fixed deposit. It may be investment in commercial paper. It may be investment in something which is not a mutual fund units. So it's not issued by a body corporate, but it is an investment. So 179 will be available to all, will be applicable to all, but 186 is applicable to only a particular class of investment or particular nature of loan. And therefore, there unanimous approval is required, and here a delegation is possible. But a fine reading of it tells us that 179 uses the word giving, making, granting, providing, and 186 says sanctioning. Now, these two words have a different meaning. Those who come from a banking background, they understand that sanction first, sanction is like a in principle approval, and then actual giving, lending, granting, providing happens. 179 uses the word giving, granting, providing. 186 uses the word sanction. I think this is enough clear that sanction has to happen at a board meeting, and then delegation even can be actual giving, guaranteeing, providing, investing may happen, or make investment may happen at a committee level. But a sanction definitely has to happen at a board meeting, unanimous, with consent of all the directors. So this is about it. Many times when I am providing a security of my own property, it is regulated under two scenarios, 186 also and 180 also. Because 180 talks about disposal or otherwise of an undertaking. So if we are creating a security on an undertaking, then it may tantamount to otherwise disposal of an undertaking. And therefore it may trigger section 180 and 186 both. You have to be careful. However, as I shared earlier, while making investment in securities or disposing my subsidiary investment in subsidiaries, section 180 will not trigger. This is because of Bombay High Court pronouncement on Brook Bond India. However, now for listed companies, if you are a material subsidiary and if you are disposing of that subsidiary or losing control on that, then definitely you will require shareholder approval, not under 180, but otherwise. And therefore, these are some key nuances which we have to keep in mind. Similarly, the word person coming under 185 also and 186 also. Person word is not defined under Companies Act, but person word is defined under General Clauses Act. And General Clauses Act is a very ancient act of the earlier 18th century, not amended, not replaced, fortunately, for very long. And it says that person includes a company and includes an association of individuals, whether incorporated or not. And therefore, it covers any kind of an association of individual, whether incorporated or not. So it will cover partnership firm, it will cover company, it will cover LLP, it will cover individuals, it will cover directors, relatives, everyone. And therefore, person is a very broad term. Trust, whether it is a person or not, there are different pronouncements. And there are some pronouncements which say that trust is a person. There are certain pronouncements which we say that trust is not a person. For example, in Gujarat, when there was an Urban Land Ceiling Act, some of the individuals formed different private trusts and acquired some properties in those private trusts, and individually also they were acquiring properties. And they were claiming that trust is a separate person. I am a separate person. My wife is a separate person. And these 4 private trusts are separate persons. Because person under General Clauses Act includes an unincorporated body of individuals. Their Supreme Court said that no, trust is not a, because it's a private trust where you are only the beneficiary. And therefore, Urban Land Ceiling Act exemption you cannot avail. Whereas when we look at 185 or when we look at 185 is about person which are private limited companies or body corporate. But 186 is about any person other than an employee. And therefore, an employee is not a person, but otherwise every individual, non-individual, body corporate or association of individuals, all of those will be considered as a person. So even if you are giving money, lending money to a trust or an HF, it will definitely get regulated under 186. These were the guidance given under, as I narrated earlier, that ICAI has given a guidance about how do you determine what is advance in the nature of loan, which can be helpful for us for determining. So how do you read Reddy Mehta and Sriram Mills case versus this loan represented by book debt? Very clearly, loan indirect is a hopping kind of a loan or something which is camouflaged as loan, but actually not on the paper, not as a loan, but actually a loan. And Reddy Mehta said that what is not a loan, you cannot consider it as a loan. So how do I determine these parameters? Can be a good guidance which is given by ICAI with respect to their members when they have to comment about CARO, and these parameters which we discussed a while ago can be useful for the participants to determine. Going forward, 186 is all about loan, guarantee, security, investment. But from the context of loan guarantee and security, we all know that it has a limitation that you cannot give loan or guarantee or security or investment more than 60% or 100% of the paid up, 60% of paid up capital reserve and premium and 100% of the free reserves. Interest charging is mandatory. However, since employees have been exempted not considered as person under 185(2), and therefore 186(7), 186(2), and therefore 186(7), which talks about charging interest, will also not apply to it, because 186(2) is a charging section, and without 186(2) there is no compliance which may trigger. In 186, 186(1) is separate, and 2 to 10 are in same family. So loan interest charging is mandatory, and it has to be equal to the yield on the government securities. And we also require board of director approval and a public financial institutions approval even. Loan given to wholly owned subsidiaries, we need not count it while calculating the limits, but the interest charging definitely will have to be done. However, loan given to an employee will be exempted from 186 in toto. Sometimes I feel, Dwarkanathji, that probably the best place to provide exemption to employees loan would have been 186(11) and not 186(2), because that has created a lot of dilemma in the minds of many members, that it only gives exemption, and therefore for the purpose of calculation of limit, I will not consider loan given to employees, but charging interest I have to do, making entry in register I have to do. That kind of view exists amongst the members. In my view, without 186(2) is a charging section. Like in 197, if 197(1) is not applicable, then we don't consider other subsections of 197. Although 197 other provision uses the word company and 197(1) uses the word public company, still that company word under subsequent subsections of 197 we read in the context of 197(1). Similarly, 186(7) will have to be read in the context of 186(2), because that is the charging section. That tells us which loans, guaranteed securities, investment are regulated under 186(2). It is to a person or to a body corporate. If the loan is not to a person, 186 does not apply. An employee is not a person. Now somebody jokingly, if some union leader may hear me saying this, he may say that, what are you saying? But that is in the context of person for the purpose of regulating under 186(2). Otherwise, definitely every individual is a person. So loan to employees interest is not required to be charged. Wholly owned subsidiaries, you have to charge interest. Sometimes many companies who have overseas subsidiaries, they have this challenge that the interest rate in overseas entities is very, very less. And therefore the rate of interest, whether they have to match or a yield on interest they have to match. So very clearly, MCA via its circular 9th April 2015, they have clarified that we are not talking about matching rate of interest, but yield on those on that lending we have to match, and yield may factor exchange fluctuation, yield may factor tax arbitrage, and so on and so forth. So therefore, yield is different than the rate that we have to keep in mind. Similarly, if I'm a non-banking finance company, I have been given exemption under 186. But under 185, if it is a loan given to a director or relative of director or to holding company director or to any other entity, person in which director is interested, then you may have to charge interest only, then you can claim exemption. So although you may get exemption under 186, but if it is a related party, quoted unquoted under 185, to definition of a prohibited party, then the charging interest would become mandatory. And even from the context of related party transaction, the transaction has to be an ordinary course and arm's length. One common question, whether loan is a service. Many times, Dwarkanath sir, I have observed that 188, such an important provision under Companies Act, the words used in 188 are not defined in Companies Act. Goods, not defined. Service, not defined. Property, not defined. Leasing, not defined. Material, not defined. Now, share is a goods or property or both. Whether loan is a service or not. Whether it is loan of service or for service. You would recall under 297, their employment services were not covered under erstwhile 1956 Act in 297, but were covered under 314. In 2013 Act, there is no such concept of loan of, for. Those dichotomy, those anomaly has been eliminated. And every service, whether employment or otherwise, it's considered as a service. Whether service is defined in dictionaries, service is defined in other statutes, not in Companies Act. Like I said, sometimes they don't define what is the definition. So Consumer Protection Act says that service is a service in the nature of lending. Now, what is service is a service. Competition Act said service is a service which includes financing. Okay, service is a little tricky part, but financing and lending is under Consumer Protection Act and under Competition Act is covered as a service. Under GST Act, it says that service, here they are going little meaningful. They say that service means anything other than goods and money. So money is also not a service, but they say that includes use of money. The use of money is definitely a service, and for the purpose of collection of taxes, they may say that we will not levy GST on the interest, but only on the processing fee charged by the lender. That is from the context of taking care of economy. Otherwise, the borrowing cost will go up 20% higher. And therefore, they don't charge GST on the interest. That's their commercial call, looking at the larger interest of the economy. What is service under dictionary meaning? Anything which is helping, serving, benefiting other. That is what Law Lexicon or Oxford says, that anything, something a customer, anything which a customer would like to do other than producing goods. And therefore, it is not free from dichotomy what is service and whether lending is a service for the purpose of Companies Act. There is one view which exists that since there is a 185 and 186, therefore 188 should not apply. But in Companies Act, there are so many provisions to which multiple sections apply. For example, if you are coming out of private placement of equity shares, and that is sweat equity, then 62 will also apply, 42 will also apply. Sweat equity provisions and corresponding rules will also apply. Many provisions we see that where there are multiple sections become applicable. And therefore, I am unable to conclude that why loan will not be considered as service. I am unable to conclude. I have not got any substantive argument in favor to say that loan is not a service. We have to remember the exemption given under 188 is to ordinary course and arm's length. And as I started in my opening slide, that firstly, all judiciaries feel that unless you are a non-banking finance company or a bank or a CIC or any such nature, lending guarantee security is not an ordinary course of business, unless it is to your wholly owned subsidiary or otherwise, wherever you have common economic interest. And therefore, if 188 is applicable to the transactions which are not in ordinary course and arm's length, if that is the context in which service has to be interpreted, then what is the interpretation is leading towards is my worry. And 188 is under adjudication power of Registrar of Companies. We have to remember there are around 2,000 adjudication orders have been passed so far from various local Registrar of Companies. And therefore, before ROC starts taking this view and be responding it later, we may look at it, re-look at our earlier stand. For listed companies, it is solved because they don't look at, then they have not used goods, services, property, and all of that. They have simply said that transfer of resource, obligation, and service, it's period. So for LODR, for a listed company, the job is simple. Loan is related party transaction. For an unlisted company, 188, such an important provision, all words used in it have not been defined. So this was one point which I thought I will share with the participant with respect to some care which we have to take when we are proceeding with loan guarantee security transaction. If it is a related party, and first we have to ensure that it's not a prohibited transaction. It should not be ultra vires your memorandum. For example, guarantee security, courts will say that it is ultra vires your memorandum because you are mortgaging your property for somebody else's loan, which is not your subsidiary or wholly owned subsidiary, where director is the personal interested. Courts may challenge it, the validity of this transaction, or 185(1) or 67(1). Those transactions, if those are not prohibited and with related party, then audit committee, and then you will require shareholder board approval where only non-interested director can participate at the meeting. And then 166 is also there. I will not go into this 184(5) to somebody who is taking a related party series might have covered this already. But an interested director, principal is in 166. subsection 4, and rule is in 184(2). And therefore, I feel that wherever there is a principle and rule, we have to comply with both. And rule cannot supersede principle. 166(4) says that director should not put himself in a situation where his interest will conflict with the interest of the company. And if we read 184(5)(a), it says that nothing contained in this section will impact any other rule of law which deals with how do you deal when there is a conflict of interest. So we have to be careful about giving supremacy to 184 over 166. So wherever director has interest, direct or indirect, conflicting with the interest of the company, he should abstain, and that's the best compliance which he can do. If the transaction, multiple sections say that transaction should require shareholder approval. 188 and 186 will require only when the transaction is beyond a particular threshold. But 185 and 67 will require if the transaction is of particular nature, right? And then you have to give full disclosures. If the transaction is going to 188, then the related parties will not be allowed to vote. That care we have to take. Public financial institutions' consent also we need to take. SEBI has already clarified in one of its documents that guarantees and securities one can give only if it has the economic interest in that particular borrower's borrowing, which is very, very logical. If company does not have any economic interest in giving guarantees or securities, why will the company and board of directors pass that resolution? And if they pass a resolution, is it in the best interest of the company, and will it be fulfilling the fiduciary responsibilities of the directors? And therefore, we have to be very, very careful, particularly for group companies guaranteed securities. If the director pass a resolution, or even if private companies claim exemption under 5th June 2015 notification, can a director give loan or guarantee or security, particularly guarantee and security, for any borrower where my company does not have any economic interest? You do not require any rule of law to say that director have to discharge their duties in the interest of the all stakeholder, and it cannot be in their own interest or in their relatives' interest. And therefore, we have to be very, very careful about guarantees and securities. How many questions have come up so far? Approximately, we have.
Sir, more than 20.
Okay. I will talk about 15-20 minutes more, and then we'll go to question answer. Is my speed enough, or I'm going to?
It's okay, sir. Yeah, in my view, it's okay.
Investment, loan guarantee security we discussed. Now we'll go to the investment part of the discussion. Again, in investment also there are prohibited investment and permitted investment which are regulated. 67 is a prohibited investment. You cannot purchase your shares, and you cannot finance purchasing of your holding company shares. Section 19 prohibits purchasing your holding company shares. Section 186(8) says that you cannot make investment, give guarantee, provide security if you have default in deposit payment. 187 says that you cannot make an investment which is not held in your own name. And 186(1) says that you cannot make investment beyond 2 layers of investment companies. And 287 says that you cannot have more than 2 layers of subsidiary. So these are a prohibited list. Whenever there is any transaction, particularly about investment, we have to go through these examinations, that it should not be purchasing your own or your holding company shares. There should not be a default with respect to your existing deposits. There should not be any investment which is not held in your name. And there should not be any investment going beyond 2 layers of subsidiaries or 2 investment companies. So these are negative provisions about investment which we have to keep in mind. And then other than that, then we have a little bit simpler process with respect to under section 186 and 179. As we discussed earlier, 186 is about investment in securities in the bodies corporate, whereas 179 is about any investment. And therefore, if the investment in securities which are not issued by body corporate, that will be regulated under 179 but not under 186. Or it is investment but not in securities, then also it will be covered under 179, but not under 186. So some examples, some questions which keep coming is that whether if I subscribe to debenture, is it a loan which I am giving to the issuer or an investment which I am trying to make? Definitely, in Sahara case, Supreme Court has settled that debenture is considered as securities. Even in Schedule 3, a subscriber to the debenture mentions this under the heading investment and not under the heading of loans. Similarly, there was an income tax pronouncement which says that for the issuer of the debenture, it is a borrowing, but for the subscriber of debenture, it is an investment. In today's scenario, when debentures or the bond market is becoming bigger than the equity market or has already been grown bigger than the bond market, multiple investments happen in the bond market and those are not lending. If someone calls it as a lending, then it will become very, very difficult compliance from the purpose of compliance of 186 or otherwise. And not just because it becomes difficult compliance, but because it is an investment in the securities. Those investment can be sold in the market. Definition, essential ingredient of securities definition is one which is marketable is considered as security. What is marketable is tradable in the market. There are 3 landmark pronouncements about what is securities. Bombay High Court pronouncement of Daiben Umed Bhai is the important pronouncement. Then Naresh Agarwal is a Supreme Court pronouncement, and Bhagwati Developer is also a Supreme Court pronouncement. All these pronouncements collectively definitely tell us that one which is freely tradable is necessarily marketable, and one which is listed is definitely tradable and marketable. But one which is not listed, even if it is freely tradable and marketable, that will also be considered as securities. Securities under Companies Act says that securities includes, and security means securities as per SCRA. And SCRA says that security includes share, stock, bond, debenture or other marketable securities of like nature. And therefore debenture, if it is a marketable in nature, definitely it is an securities and an investment. Whether mutual fund is a units is a security, yes, as per a definition of securities under Securities Contract Regulation Act, as per 2(1)(h), under 1(h), there is IB, Roman ID of the securities definition says that mutual fund units is a security. But mutual fund is not a body corporate. Mutual fund is a trust, and therefore trust is not a body corporate. Body corporate, as we discussed earlier, has to have a separate legal existence and incorporated under some statute. A trust may be registered with a charitable trust. A trust may be registered under Registration Act, but trust is not an incorporated body and therefore not a body corporate. And since trust is not a body corporate, and since mutual funds are trust, mutual fund is not body corporate. Units, investment in units of mutual fund is not regulated under 186, but only under 179. Similarly, REIT and InvIT. By virtue, by name, InvIT is Infrastructure Investment Trust and REIT is the Real Estate Investment Trust. So essentially those are trust, and trust, as we discussed, is not a body corporate. When it comes to AIF, AIF may be an LLP or a company or a trust, and therefore whether AIF is a trust or a LLP, that will have to be looked at. And if AIF is LLP, then units issued by them may require compliance under 186. But if AIF is a trust, then definitely it will not require compliance under 186. One more instrument whose listing is become mandatory, and there were a lot of questions about this as to whether commercial paper is a securities. None of the company has complied with Section 42 to the best of my knowledge with respect to issue of commercial paper, and considering as because we know Section 42 uses the word issue of securities, require compliance of Section 42. Whether commercial paper is a security. Now SCRA and Companies Act, SCRA does not specifically include securities definition, specifically does not include a commercial paper, but they definitely say that any marketable securities of a like nature. The question which comes is whether commercial paper is a securities or not. Because under securities definition of SCRA, it says that shares, stock, bonds, or debentures or other marketable securities of like nature of any body corporate or a pool investment vehicle. So the question arises, what is debenture? Debenture is defined under Companies Act, and there they say that Reserve of India may exclude certain transactions, may exclude certain instruments from the definition of debenture. And in the RBI has clarified that whatever instruments under Chapter 3D of RBI Act will not be considered as debenture. Chapter 3D of RBI Act is about money market instruments. Money market instruments are not considered as debentures, and they have covered commercial paper under the definition of money market instrument and therefore not a debenture. So although the commercial paper is kind of a borrowing which a company is doing and which is tradable on a stock exchange even, but though it's not considered as debenture, and therefore the question arises whether from Securities Contract Regulation Act or under Companies Act, commercial paper will be considered as securities or not. To help us to arrive at some conclusion, there was an amendment in Indian Stamp Act 1899, where they have defined the term securities. And that definition got amended on 9th January 2020, where they say that security includes Roman 1, security that defined under 2H of SCRA, and then they have added Roman 3, a certificate of deposit, commercial issuance bill, or commercial repo, or repo on corporate bonds. So commercial paper, they have specifically covered as a separate category. Roman 1 is securities under SCRA, Roman 2 is derivative as per RBI, and Roman 3, as per their definition, is commercial paper. So probably from the lawmaker who were amending this Indian Stamp Act, which is a central statute, they wanted to cover commercial paper for Stamp Act purpose under word securities, and they have not relied upon securities definition under Securities Contract Regulation Act, but they chose to add one more item to say that commercial paper is securities for the purpose of Indian Stamp Act. Probably that is leading to tell us that for Indian Stamp Act, commercial paper is a security, but for the purpose of SCRA and Companies Act, till the time these definitions get amended, commercial paper will not be considered as securities, and therefore investing in commercial paper may not be considered as investment in securities, and therefore 186 may not apply. However, 179 will definitely apply. With respect to the processes, conditions, and with respect to investment, we have to remember two conditions. One is that layers of investment, which we already discussed, and second is Section 192. Section 192 is one such section which is very less discussed amongst the corporate members and amongst the company secretary fraternity. This is one section which is kind of untouched by many, not focused, not in limelight. What it says is whenever a company is acquiring or disposing of any asset for a consideration other than cash, and if the transaction is with the directors of the company, holding company, promoter company, subsidiary, associate company, their promoter directors, then, and if the transaction is other than cash, then you require a valuation report and a special resolution both. Related party transaction under 188 does not require a valuation report, but 192 under Companies Act requires a valuation report to be obtained, particularly for the companies who are taking over a proprietary concerns or a partnership firm against which they are issuing shares. So if there are participants who are coming from practicing company secretary background, they may be encountering this kind of a scenario. Then over and above 42, 192 will also have to be complied with. Similarly, shares is definitely considered as goods, and share can also be considered as property, and therefore it will be regulated undoubtedly under 188 and also will require audit committee approval if the transaction with a related party. Subscribing to the shares will not be triggered under 188, but purchasing shares in the secondary market, already issued shares, then definitely it is existing goods and existing property and will require corresponding compliance. If I am a company for which my investment in shares is in investment, then definitely I will equate it with property under 188. And if I'm a regular trader in the equity market, then I will call in my balance sheet shares as stock, and therefore I will equate that as goods for the purpose of 188. I hope I am making it clear. Under 188, for goods, the threshold, the denominator is turnover, and for property, the denominator is net worth. That means for going to the shareholders' approval, if it is about purchase or sale of goods with a related party, we have to look at 10% of the turnover. And if it is about purchase or sale of property, then it is about 10% of the net worth. So if my business, or from my business point of view, this subscription of shares, whether it is investment or a stock, depending on that, I will be treating it as a goods or a property. This is a perspective which I wanted to place it to all the participants. I hope I am making it clear. There is an interpretation principle, redendo singula singulus. That means that whenever there is a numerator, a denominator has to be a corresponding. So when it is about, when I am calling shares as stock, then the denominator will become turnover. And if, because of my nature, I'm not calling it as a stock, but as an investment, then my denominator will become net worth because it's a property for me. It's about me. 188 is about me, the company which is complying. For me, whether it is the goods or property will determine whether what will be the denominator of this particular thing. So redendo singula singulus, academically interested participants may take note of this particular principle of interpretation, and they can look at this principle for interpretation and for the analogy which I have placed in front of you. Similarly, there are other covenants like subsidiary cannot hold shares, then interested director cannot participate. All of that we have discussed. When it goes to shareholder approval, depending on whether I am going under 186 or 192 or 188, depending on that, I will have to look at whether it is ordinary course arm's length, whether it is exceeding my limit, whether in 186 applies to me or whether it does not apply to me. All of that, depending on that, I will determine whether a special resolution is required or not required. Even if one section requires me a special resolution, I have to pass. Even if 188 is not triggered, but 192 is triggered. Even if 186 is not triggered, 188 is not triggered, but 192 is triggered, I will have to still go to the shareholders. Even if 186 is not triggered, but 188 is triggered, I will have to not only go to the shareholders, but a related party with whom the transaction is proposed to be entered into, he will not be allowed to vote. So these are the things which we have to keep in mind. And particularly when you complete the transaction of selling or acquiring, making investment transaction, then do not forget to file Form BAN and do not forget to file MGT 45 with respect to wholly owned subsidiaries. Last few days, we have seen the wave of show cause notices, at least here in Maharashtra. I'm not sure whether that's a practice all over. Many ROCs have issued show cause notices with respect to delay in filing Form BAN 1 by BAN 2 with the registrar of companies. So never ever forget that whenever you make investment or dispose of investment, do not forget if there is a change in SBO, then that also we have to make. And if wholly owned subsidiary gets acquired from one entity to another, then again MGT 45 will have to be filed. Do not forget to comply these provisions. Whenever I'm going to the last leg, maybe more 5-10 minutes, and then we can go to the questions. What is expected from the fiduciaries? Fiduciaries like professionals like you and me, professionals, fiduciaries who are the board members, what are they expected to do? That guidance emerges from CARO, from auditing, from the auditing standard and guidance note issued by ICAI, and also from SEBI circular, which was issued with respect to what is the minimum data which one has to consider, which the board has to consider before approving a transaction. First thing that they have to look at is whenever I'm lending or investment, what is my source of fund? Is it borrowed fund or is it my own fund? If it is borrowed fund, what is my tenure of repayment versus the loan for which period I am giving? Am I giving loan to be repayable on demand, and whether that company has capacity to repay that loan on demand? This is very interesting and important. Many times, a company with a crore of rupees capital, the group company may give 15 crore, 20 crore, 100 crore as an ICD repayable on demand. It's repayable on demand. But if the company's net worth is a crore of rupees, can they repay on demand? That's an important question which independent directors will have to definitely consider. What is my cost of borrowing versus the interest which I am charging? That also I have to consider. Where the money is going to get utilized. Is it going to get utilized for the principal business of that borrower, or is it going to get used for onward investment or lending? If it is onward investment or lending, is it indirect loan given to the director or to the relative of director or the firm in which director is interested, or whether it is investing in my own or holding company shares? That one has to validate, and those kind of covenants will have to be prescribed in the loan agreement or investment agreement. And similarly, the undertaking will have to be, warranties will have to be procured, and the utilization monitoring will also have to be done by the person who is making investment or giving loans. The decision maker who is on the audit committee or the board will also have to look at the justification of that particular transaction. Why should I enter into this transaction at all? And whether it is in the best interest of my company or not. This is what the very important pronouncements which we have been discussing since last 1.5 hour, have been throwing on us at the light. If we have relied upon some external report with respect to interpretation of a particular provision, or with respect to valuation of an undertaking or a security, then that valuation report also will have to be looked at. And then the percentage, what is the percentage of, if I am lending money to a subsidiary, how much is the total borrowing or total asset size of theirs, and what is their dependence on me? All those factors also, counterparty exposure also we have to look at. As I said earlier, guarantees and securities cannot be extended to any company unless and until there is a, unless and until there is an economic interest in the company. Otherwise, it will not only be considered as nut and void, it may trigger personal breach of fiduciary duty on the people who are approving it. Similarly, with respect to Caro, an auditor has to look at the similar thing as to what is the term loan is used, whether it is the working capital, where the working capital is getting used, what is the repayment schedule for me and whatever loan I am allowing, giving money, whether the borrowed funds have been used for the same purpose, whether my cash, whether if I have cash losses, whether giving such loan and investment will be in the best interest of the company at all. Because if I am burning money, and if I am lending my borrowed money or my fund raised in my company into some other subsidiary or group company, whether it is in the best interest of the company or not, particularly when I am running into cash losses, particularly the startup companies will have to be very, very careful about these covenants, because the board, while approving it, it is not a rubber stamp, and we have to ensure that they discharge their duties diligently. And for discharging their duties diligently, this information we can place in the board and audit committee, even if you are not a listed company. This is a very good guidance. With respect to any non-compliance with respect to any of the provisions under Companies Act, I'm at the last fact now. This is a risk, and then last slide I will talk about the risk mitigation strategy, and then we'll go to the question answer session. We have seen that 185 and 186 are not under adjudicatable adjudication mechanism. It is under 185 is a compoundable offense and 186 is a non-compoundable offense. Surprisingly, 185 has the upper limit on a penalty of 25 lakh. So a company might have given loan of 25 crore or 100 crore, but a penalty will be only 25 lakh. Whereas in CSR, it is about 2 times of the unspent amount, depending, of course, they also have put maximum limit. But this penalty seems little illogical. 5 lakh and 25 lakh. So if you have given a loan of 25 lakh, penalty of 25 lakh. And if you have given a loan of 25 crore, still the penalty of 25 lakh. So it's unfair to the smaller entity. Interestingly, 188 is under adjudicatable. Loan to director is a compoundable offense, but loan in general is a non-compoundable offense. This is something very difficult to believe. 186 is the non-compoundable offense. So if I do not charge an interest, it's not a compoundable offense. I have to get it through the court process, and whatever fine they will levy, or unfortunately, if it is sent behind bar, then that will have to be honored. I'm not sure whether in the wave of decriminalization, whether 186 was purposefully omitted or accidentally omitted. Because between 185 and 186, I feel that 185 is a little grave than 186. But still, this is a law which we have to comply. 188, 177, 184, all are under adjudicatable mechanism. 192 even is under adjudicatable mechanism. 177 and 192 does not even prescribe penalty provision. But jiska koi nahi uska khuda, or section 450. Section 450 says that wherever there is no penalty, this penalty will be applicable, and that power to levy penalty is with the registrar of companies. He may issue show cause notice. We have already been reading in newspaper. Dwarkanath ji would be definitely aware about these details since he is a central council member. That probably MCA is looking at automation of adjudication whole process. So if they go to that level, you have to be very, very careful about. One question which keep coming to me in many webinars and seminars, that if I am violating 188 or violating 177, giving loan, 177 approval not required, taken, I will be paying penalty under 450, and that's it. The answer to that is, there is a umbrella provision 447, 448, which we should not forget, which talks about whenever there is any fraudulent transaction, then 447, 448 triggers. Whenever there is a preferred transaction under IBC, then IBC triggers. And if it is ciphering, then criminal prosecution also triggers. So, although this is adjudicatable, but that does not give a protection that there will not be a criminal prosecution with respect to these violations. And therefore, what is the role of independent directors and the directors who are approving it? We have covered this in our guidance note on independent director, which was released last year, as to how independent directors should discharge their role. And there in our institutes, the guidance note to independent director, they may look at this particular publication of ICSI and all the guidance notes issued by ICSI, very, very valuable. Expert group on Secretarial Standard and now Secretarial Standard Board deliberates a lot on this particular aspect. I will urge all the members that these guidance notes are available on ICSI portal. They can please buy those, download those, whatever available format, and look at it. Business judgment rule is a Western concept under English law, under Australian law, under US law, under Canadian law, Companies Act. They say that those who are fiduciaries, if they are able to prove that the commercial decision which they took was had followed these four principles, that the disclosure of conflict of interest or otherwise to those to whomever a disclosure is required to be maintained, to be given. Second, the process is followed properly. There is a proper process, laid down process, thoughtful process for undertaking that particular transaction. A rationale for the decision making, a reasoning for the decision making is recorded. Even our Secretarial Standard requires all material and important decisions rationale to be recorded in the minutes. And the fourth period is, am I fully informed? So fully informed decision with proper rationale, with proper following proper process and making proper disclosure to everyone who is concerned. If the fiduciaries are able to take that, then definitely that becomes a defense. Many independent directors who were prosecuted either under NCLT or under SEBI adjudication mechanism, wherever they were able to prove that they had objected, or wherever they were able to prove that they have followed a process, or wherever they are able to prove that there was a reasoning for the decision, the adjudicating authorities have spared them because it's a commercial wisdom. Even if the decision goes wrong, it does not mean that the transaction is fraudulent. but the process is not followed, disclosure is not made, informed decision is not taken, and if the decision is not backed up by the rationale, then the prosecution or the adjudicating authority, wherever there is a conflict of interest, will naturally conclude that the decision is arbitrary and therefore there is a violation and a personal liability may trigger. So this is what I wanted to share with you, all the participants, and therefore in the last, I'd like to summarize on this Bhagavad Gita shlok of 16th Adhyaya 23 shlok. Yash Shastra Vidim Utsruja Vartate Kama Karata Nasa Siddhim Avapnoti Na Sukham Na Param Na Gatim. The one who does not follow proper process and goes by whims and fancies and moods and mujhe laga, I thought so, I thought that this will not be applicable, I thought this is not relevant, will be having difficulty. But one who has followed a process with proper reasoning, fully informed decision, definitely he can have a peaceful sleep and a very sustainable corporate structure, which all corporate company secretaries we can offer. We'll go to the question answer.
Makaranji, I think there are nearly 30 questions that have been lined up. I think we can try to answer as many as possible in the next half an hour or so. I'll start with the first question, sir. This is regarding under section 185. The question is it appropriate for a private company, being a holding company, to pass a omnibus special resolution to give loans to all its subsidiaries? Individual limits are not specified. Interested directors cannot be determined upfront. This is the question that they have put.
So, as I said earlier, 185(2) expects that we have to give full particulars of the particular transaction which we are proposing to do. If the loan is to its own wholly owned subsidiary, then still it can be a safer bet. But if it is to a non-wholly owned subsidiaries, then the difficulty level increases. We also have to remember that the end use will have to be looked at very, very carefully. And who is going to object, that also one has to look at. Particularly, if it is a wholly owned subsidiary of some company, and that company has given a consent for its onward lending or transaction under 185, then one may take a practical view that I have categorized, although I have not mentioned the names of all my subsidiaries, but I have mentioned that this resolution is valid only for loans which I am giving to my subsidiaries. Wholly owned subsidiaries is anyway exempted under 186(3). Loans to subsidiaries, that kind of a disclosure can also be good enough. But if it is not to wholly owned subsidiaries, and if it is to, you cannot mention any company which the directors may deem fit. That will be a very, very dangerous situation. One case law I had quoted in my PPT, which clearly highlighted that if full disclosure is not made to a shareholder, and if it happens that if you are not a wholly owned subsidiary of one holding company, and if you have multiple shareholders, then the risk of some minority shareholder raising a question about some investments made in a some loan made to a subsidiary where director has a personal interest, then the minority shareholder in your company may drag you, and that can pull you into a trouble. And therefore, using it for subsidiaries where director has a conflict of interest is not at all advisable. So a caveat one can put that it's available for subsidiaries where none of the director or holding company director has any conflict of interest. Then it may be safe, provided you are again subjected to a holding subsidiary. If you are subjected to a group of individuals who have diverse views, then we have to again be careful about these aspects. Two scenarios, whether your shareholder is one and whether there is no conflict of a director. Even if you are able to avoid no conflict of a director, still it may be a safer bet to pass such resolutions if there is no minimum information which is required to be disclosed. And I am trying to narrate on what is this full particular and how one can mitigate the risk. Yes, sir.
Coming to the second question, this is under section 179, subsection 3, requires a board of directors resolution for investing the funds of the company. Does this word invest includes disinvest also? Does disinvestment requires a board of directors resolution under section 179(3)?
Unfortunately, this is not a very settled law, and so far we have been taking a view that investment is an affirmative action of deploying your funds. Withdrawing your funds is specifically not covered here. Although in LODR at some aspects they cover, but 179 does not cover disinvestment. It is better that you pass, but it is not non-compliance if you do not pass.
Thank you, sir. Next question, whether book debts will also be considered as loans under section 186?
186 is again saying that directly or indirectly cannot be a loan. So anything which is not a loan as a title, but underlying there is no transaction and therefore it is an advance in the nature of loan only, then you run a risk of it getting covered even in 186. Because as I said earlier, what you cannot do directly, you cannot do indirectly. But that does not mean that every book debt is a loan. Every book debt is not a loan. And for that, you can rely on Shriram Mills case and Freddie Mehta case. These cases you can find out from internet. Those are available. Academic interest you can satisfy. Every book debt is not loan, but something which is camouflaged as book debt, but actually a loan will be a loan.
Next question, sir. What is the limit up to which a private limited company can lend money to sister company under the Companies Act 2013?
Private company, if it is enjoying the exemptions under 5th June, 185 does not have a limit, but 186 has the limit, and 186 applies same dicto to private and public companies, and therefore these limits will have to be complied with.
Sir, next one is an interesting one. Whether a private limited company can seek business loan with or without interest from the managing director, and if so, any limits prescribed under the Act 2013?
Company taking loan from a director,
yes,
director out of his own funds, then it is not a deposit, and therefore not exempted deposit, and therefore there is no limit. And even if you do not, if the director does not want to charge interest, he is very generous, then there is no problem. Even if you consider loan as a service and we are availing service from a director, even if we take that view, arm's length definition under 188 is as if I would have dealt with a third party. So even if third party would have given me interest-free loan, I might have taken. So long as it comes from a clean hand, of course, because otherwise PMLA related questions may come up. But if it is coming from clean hands, I don't mind, or a company may not mind, even if they take loan, interest-free loan from a director. There is no problem with respect to arm's length even.
Sir. Next question. Is the exemption related to section 185 why the MCA notification dated 5/6/2015 is still valid or not? Despite the section 185 having been completely replaced by the Companies Amendment Act 2017. Please guide.
My view is that they have not withdrawn that notification, and therefore it is still valid. There is one interpretation principle that whenever there is an amendment, there are two principles. Whenever there is an amendment and if two provisions contradict with each other, then the latter will prevail. Here there is no contradiction. There is no contradiction. 185(2) gives a relaxation, 185(3) gives a relaxation, and private company exemption also gives a relaxation. So there is no contradiction. And another principle is that if I am getting multiple exemptions, I will be allowed to use multiple exemptions. There is no bar as per interpretation principle. Second is that with respect to any amendment, whenever there is any amendment, there is a principle that whatever other provisions are there, the lawmaker are aware, and if they have retained those provisions, then it is presumed that they are okay with it. They are okay with it.
Sir, again, there is one interesting question. It is relating to term deposits. The term deposit is considered as investment or not? If yes, a prior approval of the board is required.
So investment, term deposit is an investment from the context of depositor, but it is not securities, and therefore 186 will not apply, but 179 will apply to this investment, and they will require board approval at the meeting or a delegated power to the allowed executives.
Yeah. Can a company purchase shares of a listed company and do trade and sell?
Of course, yes, they can. The only thing is that you just ensure that while we discussed about this loan investment, do not forget that your company should not become a non-banking finance company. And that threshold is 50-50. 50% of the asset and 50% of income. So don't fall into that. Otherwise, no problem. It's a treasury investment of your surplus funds.
Next question, sir. Can a private company give?
Don't use the borrowed funds, because otherwise it will be a violation of your borrower covenants and it may trigger non-consequences.
Yeah. Sir, I will go to the next question. Can a private company give loan to partnership firm? Partners of the firm or the relatives of the directors of the company?
Private company, if it is not exempted as per 5th June notification, you cannot give loan to a director because it is prohibited under 185(1).
Next question, sir. Whether intercorporate deposits given to other bodies corporates falls under section 186 of the Companies Act and treated as loans?
It is definitely falling under 186 under loan category.
Next question. Can you please elaborate how transactions between sister concerns can be fully complied? What are the points a CS should keep in mind while evaluating the transaction?
It's a loan or investment?
Yeah, it says transaction between sister concerns can be fully complied.
The first slide which I had shared, and this video probably will be uploaded on the YouTube also, so the reader may look at. There is the jungle of sections which is applicable, which you have to take care. And the whole 1.5 hour was only on that. That it's not one section.
Yeah. When two private limited companies have taken loan from NBFC as applicant and co-applicant, then what will be the procedure if the loan is transferred from applicant to co-applicant if it exceeds the limits as provided?
If it exceeds the limit?
Yeah.
So I have to look at from the borrower or from a lender. I'm not sure. But for a lender, 186 is exempted. 185 will also be exempted. 67 he has to take care that none of the co-borrowers should borrow. And as far as co-borrower covenants are concerned, we have to ensure that these co-borrowers both are borrowers, and borrower obligation will remain unilateral to both of them, and anyone can be liable, and both will have to comply with whatever applies. So if I am a party under 185(2) and Dwarkanath ji is not a party under relative 185(2), and we put together private limited companies are borrowing, then still I will be considered as a borrower and therefore will be regulated under 185(2) if that is the question.
Can a company give interest-free loans to its employees?
It can give interest-free loan to its employees under 186. It is exempted.
Next question. A private limited company gives loan to B, private limited company without complying with the provisions of section 185 as well as section 186 of the Companies Act 2013 as reported by the statutory editors. What are the consequences apart from the penalties provided in the Act itself? Can it be treated as financial debt under IBC?
Can it be treated as a financial debt under IBC? I'm not able to respond to this question. If you want to respond, sir, you can please respond to this.
Yeah. The next question, how to decide any body corporate, the board of directors, managing director or manager, whereof is accustomed to act in accordance with the directions or instructions of the board or any of the director or directors of the lending company under section 185 of the Companies Act?
There are many pronouncements which say that your ability to appoint does not mean that, or your power to appoint them does not mean they are accustomed to act. Neither because I am related to you would mean that I am accustomed to act as per your instructions, or you are related to me, therefore you are accustomed to act as per my instruction. That analogy one cannot draw. Two scenarios which I had shared in the session also. One is that the person who is a director is not a fit and proper, in the sense their credential, their ability, their experience does not go well with the expected profiling which a director should carry, and the decisions which these directors are taking, if those are erratic, illogical, and based on the instructions of the another group company director or board members, then it will be considered. So two scenarios can be the litmus test which one can apply, not otherwise. And to avoid this allegation, recording rationale becomes all the more important. In one of the very recent pronouncement of SEBI, where one listed company had disassociated one of its associate company into reduce their holding from below 20%, and that entity in their board meeting said that we have no exposure about carrying out this business, and all these decisions are taken by this listed company. Now, if the board of that entity itself says that we do not have the know-how and expertise and we work as per the instructions of that listed company, that will also prove that it is accustomed to act. So your own affirmations at some forum or these two parameters can be the parameter which may consider.
Sir, the next question is relating to use of the borrowed funds for principal business activities. The question is, as per section 185 subsection 2b, the loans are utilized by the borrowing company for its principal business activity. So, can we give loan to LLP being a body corporate? I think you have covered in your presentation, but still.
Actually, if the body corporate contemplated under 185(2) is such body corporate which has board and which has total voting power in the context of general meeting. LLP is a partnership. There is no separation of management and ownership in LLP. There is no concept of board. Designated partners are only partners liable for the compliances. They do not enjoy powers like board enjoy under section 179(1) of Companies Act. So designated partner and partner is not same. There is no concept of board. There is no concept of ordinary resolution, special resolution. There is a concept of majority partners and unanimous partners. So the total voting power which is used under total voting power term is defined under Companies Act, which talks about total voting power to be exercised at the general meeting, and general meeting decisions either happen by ordinary or special resolution or some other threshold. So paid up capital based voting structure, which is the essential characteristic feature of total voting power, is also absent in LLP. My contribution and my voting power, my contribution and my profit drawal capacity have no linkages in LLP, and therefore the body corporate contemplated, is LLP a body corporate? Yes. But is it a body corporate contemplated under 185(2) explanation? Answer is no. Answer is no.
Yeah, interesting answer. Next question is, can a private company give loan to LLP in which a relative of a director of a lending company is a partner of LLP?
My personal view is that LLP is partnership and also a body corporate. 185(2) is not applicable to me because I am not that kind of a body corporate, and 185 is the negative provision. And therefore,
again, there is a related question. Can LLP, being a shareholder of a company, gives loans to company whose shares LLP has acquired?
So LLP is the body corporate, definitely from the context of the 5th June notification exemption. If LLP is your shareholder, you are not eligible to claim exemption. See, LLP is a body corporate for sure. For 5th June, it is definitely a body corporate. For 185(2) explanation, they are talking about two characteristics. Not every body corporate is coming under 185(2). It is only particular body corporate which will get covered under 185(2). But LLP is the shareholder, it is shares held by a body corporate, and therefore which will disentitle you as a private limited company to claim exemption.
I'll go to the next question, sir. If the subsidiary was only one subsidiary and the loan is taken and subsequently the subsidiary becomes a simple subsidiary, what are the consequences of that loan? Are we required to take necessary approvals? And if yes, what is the trigger date?
So this compliance will have to be looked at, in my view, when the transaction is entered and not subsequently. There is no provision which says that the subsisting transactions will also require certain compliances. So if at the time you were wholly owned subsidiary and you took exemption, that's it.
Is MGT 14 is required to be filed when a public company forms a wholly owned subsidiary company under section 179 subsection 3E? Will it be considered as investment of funds under section 179 3E?
No, not. I'm sorry, I could not hear you properly. Can you repeat again?
I'll repeat, sir. Is MGT 14 required to be filed when a public company forms a wholly owned subsidiary company under section 179(3)? Will it be considered as investment of funds under section 179 subsection 3E?
So 179(3) is about passing a resolution. It's not about actual investment. Once you pass a resolution, the form will have to be filed. There is no link to the actual investment. There are certain transactions where you require resolution to be filed, and there are certain transactions where certain reporting which you have to do when there is a change. For example, director appointment. You will file a form after the date of appointment. But with respect to certain things, passing of resolution itself is a trigger and not the actual investment. So once you pass a resolution, you will have to file.
Thank you, sir. There is a very lengthy question. Section 186 subsection 6 says no company which is registered under section 12 of the SEBI Act 1992 and covered under such class or class of companies as may be prescribed shall take intercorporate loan or deposit exceeding the prescribed limit, and such company shall furnish in its financial statement the details of loan or deposits. Does this mean SEBI registered entities like broking companies, asset management companies, CRA, etc. cannot give or take loan in excess of section 186 subsection 2?
So definitely it will cover broker, asset management companies. I'm not sure. Asset management companies have been permitted specifically by SEBI to many mutual fund companies may be permitted. So broker for sure. We have to look at section 12 related guidance coming from SEBI particularly to answer this question.
I am going to the next question, sir. One second, please. Whether corporates are allowed under section 179/186 of the Companies Act to invest in fixed deposit schemes invited by the listed corporates like Bajaj Finance or Mahindra Finance.
They are allowed.
Is it not intercorporate deposits under the Act?
Is it not intercorporate deposit? Now that intercorporate deposit under 73 acceptance of deposit or under 186, because 186 talks about loan and investment and guarantee and security. They do not use deposit word. So it's a definitely regulated under 186 for sure, and it gets exemption for it's a non-banking finance company anyway. They have different definition of deposit. So for both the companies, it is fine.
Yes. Going to the next question, sir. Whether power of board of directors of a company for giving of loan, guarantee, and acquiring securities of a body corporate under section 186 subsection 2 of the Companies Act 2013 can be delegated to a director/directors or committee of directors or specified individual. Does board resolution require each time of giving loan guarantee?
I mentioned earlier the difference between 179 and 186 is that 179 uses the word granting, making, providing, giving, and 186 uses the word sanction. Whenever there is a sanction, there has to be a whereabouts about the KYC of in whose favor this sanction is given. So sanction, if it talks about names of the entities and the terms or some investment policy is adopted, and as per those policies, as per those names, if they want to delegate that power to the permitted entities under 179, that should be fine. If you do not provide any details, then it's not sanction. Sanction necessarily has some KYC about in whose favor this power is going to get exercised.
Sir, next question, sir. In case of a private company, advance given to directors for expenses. How this same shall be treated? After a year also, the director has not spent the whole amount and the amount is still stands same. Please clarify.
So there was one High Court pronouncement about advance salary given to the wife of a director, where High Court clearly said that salary advance is not a loan. Similarly, in Shriram Mills and Freddie Mehta, they say that if it is for business purpose, it's not loan, and therefore non-encashment or non-recovery does not mean that it is a loan. However, so by default, it will not be considered as a loan. However, if this is a practice and the value is disproportionately high without any reason, if there is anything suspecting, then one may look at it differently. But genuine transaction, it's not a loan.
Yeah. Thank you, sir. There is a very big question which I'll read out. A LLP has its entire capital funded by a single company. The directors of this company have taken up roles as designated partners within the LLP. Among these directors, one holds a portion of the capital as a nominee representing the company. This arrangement is primarily made to meet the requirement of having at least two partners.
Correct.
Given these circumstances, can it be argued that extending a loan to this LLP is not subject to the provisions of Section 185? This interpretation is based on premise that the director acting as a nominee partner is not pursuing personal interest, rather their actions are confined to the following the directives of the company.
185.1 is a rule and a negative rule. So in this situation, particular director is a partner and also a designated. Had he not been a partner and only designated partner, then I would have taken clearly a view that designated partner who is a nominee but not a partner is not a partner. He is a nominee of the partner, and therefore there is no problem in 185. But if it is a partner also, then there is a trouble. Avoid making director a partner. If you have any arrangement whereby it is said that this particular partner is holding this stake in LLP on behalf of that particular company, then that can be a good argument. 185, fortunately, unfortunately, incidentally, is not under adjudication mechanism, and the courts will hear this. And definitely courts would look at it that if he's a designated partner and not a partner, there's a difference. If an individual is a nominee and of a partner, then I'm not a partner, I'm nominee. And therefore 185.1 will not trigger. And even if I'm a partner, but actually the beneficiary is company, even then you can take this view that 185.1 is not applicable. This is a little bold view. Be ready for litigation. And if the stakes are so high, one can take this view. If you want to be conservative, if the stakes are not very high, if you cannot fight to the, because this first will go to the local metropolitan court, then it will go to the High Court and then Supreme Court. So if the stakes are high and if you're ready to fight on those merits, then do. Otherwise, don't venture into it, because 185.1 is a negative provision.
Thank you for that response. Coming to the one more question. Kindly elaborate, interpret the limits prescribed under Rule 16(1)(d) of the company's share capital and debenture rules 2014, which provides that the value of shares to be purchased or subscribed in aggregate together with the money provided by the company shall not exceed 5% of the aggregate of paid up share capital and reserves of the company. Can we interpret the above rule to consider this limit as an annual limit? He's talking about the annual limit.
No, it's a continuous limit. It's a cumulative limit. It is a cut. Any day when you are making investment, we have to look back and see what is my limit, what is my paid up capital as that last audited number, and what is my net free reserve and premium as that last audited number, and then look at what is the outstanding loan investment guarantee security. And if there is a limit, you can, if there is a space, you can invest or lend or give guarantee. Otherwise, you cannot. You have to go to the shareholders and extend this limit further.
Fine, sir. We have come to the last question, which I had already posed. And I can say, sir, this is, I think, where the participants were almost 9,296 participants today to view your presentation. On behalf of the Institute of Company Secretaries of India, I wish to say that the way you covered the sections starting from 185, 186, 179, 188, it is thought-provoking. In fact, we think that, okay, we know, but still there is a lot of things which we have to know and continue to know. And the way you covered the investments, the providing guarantees or investments, it's mind-boggling, in fact. And I can say with your presentation, we have been enabled, in fact. We have been enabled to, we have learned so many things and we have excelled, in fact. That EE stands for that today's webinar. And you have dealt with so many case laws practically which have been decided by various courts. I think that is going to be a very useful input for all of us. And in fact, I can say that the seminar today's seminar is really wonderful for for sharing your thought process, and of course there are a lot of takeaways for us. In fact, in today's seminar, I once again thank you, Makarandji, for spending your valuable time and sharing your thought process. Thank you very much on behalf of all the participants. Thank you very much.
Thank you, sir. Thanks for the opportunity.
Thank you. I thank the participants as well for their questions that have been posed to the Makarand Joshi ji. Thank you. Thank you.
Thank you.